All right, welcome everyone. Can someone please type in the stream chat if you can hear me loud? Can you hear me loud and clear and all that kind of good stuff? And can you see my screen? I'd appreciate if someone gives me the heads up. Welcome everybody. All right, there we are. Well, welcome everybody. Sean is the name, and I get the privilege of getting to kick off Infinity, which is a wonderful compliment. I'm happy to be part of the team. And tonight we're going to be discussing how to treat your trade like a business. And to me, I would appreciate it if we could make this as interactive as humanly possible. So to me, I'd rather it be more like a conversation. And so don't be bashful. Feel free to ask questions. Obviously, I'm going to be broadcasting content to you this evening, but I'd appreciate it if any thought, any question, don't be bashful. You're not going to scare me. I've probably heard it before. So speak your mind, comments, questions, and I need to benefit and remind all of you this is for you. So all the more reason to make it interactive and ask questions. Okay, so it looks like everybody can hear me and you can see my screens. So let's go ahead and begin. All right, so welcome. So the topic at hand this evening, we had the privilege of building out, Eagle Infinity, and we're taking a different spin on things. Kind of holistically what it is like to be an investor trader as an entire bigger picture business model. And so first and foremost, if we talk 101, we have to build a foundation. So this week we're going to be discussing treating your trading like a business. And this evening, it's kind of a mission to help you get the beginnings of building a trade plan or a business plan document for yourself. And let's face it, we need instruction manuals. Otherwise, it's just chaos. And to create that discipline, accountability, all those kind of good things. And then also this week, I'm going to be joining you and jumping in and doing the journaling session. And I have a unique perspective. I'm a person that, active trader, and then I've ran active traders, and I've also pushed traders for peak performance. So I have a unique perspective, and it sounds like a dull topic like journaling, but I think you'll find it enlightening and just a different perspective, because to me, it's like first you need to become consistent, profitable, then we have to drive you to be more efficient about what you do. Okay, if that makes any sense. Okay, so let's begin. And let me know if you have any comment questions as we go through our journey here. All right, so can everybody see my next slide? Would someone give me a heads up? Man, look at that picture there. So Sean is the name, if you didn't know my name, and I'm a co-director with Infinity, and I've had 20 years at this game, being an active trader, mentor, coach, and I like to think I'm an amazing guy. If you buy into that or not. Okay. And I could give you like the down and dirty. To me, I have been a prop trader. I've ran my own trading floors. I've been a senior broker with Schwab. I was on the institutional desk as well with Schwab. Ended up running and being an advisor. Then I ended up running advisors, 150 of them across 8 states with a firm called SagePoint. Other than that, since all that madness at a young age, I've basically just been a consultant at this juncture of my life. So Eagle, asked me if I'd be a part, and it's been a fun journey since. Okay. Here we have kind of a roadmap, and here's kind of where we want to travel in our journey this evening. Okay, and so to me, first and foremost, the whole concept of why do I need to do this, and I guess a fun word I could say is structure. The structure is no fun, but we need it when it comes to getting consistent, creating a set of instructions for yourself. And I think another good word other than structure is creating a system. And I think the fun part about McDonald's, if I use a reference, McDonald's, a lot of people will argue either they're a real estate company or they sell systems. And that's how they pitch it when you're trying to purchase a franchise, is that you have to create these systems. And so all you're doing is like, okay, I need to look at, system number 23 on how to make a cheeseburger. And so that's how they can sell these franchises. They're like, you just need to follow the system. because if your McDonald's franchise is falling flat, they'll point it back to, well, you're probably not following the system. Okay, and that's a good analogy for trading. And I can get people to type in the chat, but I'm sure several of you have not actually created a structure or created a system. And the cheesy analogy I like to share over the years is a quantifiable, repeatable process. Okay, and you got to have an instruction manual to start with. So that's what we're trying to spearhead this evening. Okay, so obviously, the number two here is creating a business plan. Okay, and you see this analogy where it's like, creating an instruction manual. And the first time I had like a DVR machine, I can date myself, but now everything's in the cloud, but a digital recorder, I had to look up the manual on how to use the darn thing. Same thing. It's like you're going to create this trade plan document and instruction manual, and you're going to keep referencing it. Okay, and then you have to create a system of discipline if you don't follow it, and then a reward system if you do follow it. So we'll touch on these things as we progress in this session together. And to me, it says it down here, establishing checks and balances, and a reward system, but then also a system of accountability, or a system of discipline, or a system of I'm not gonna say punishment is a terrible word, but like, if you exceed your weekly, um, what if you exceed your daily loss rate? Like, let's say you're only going to lose $100 a day, but then you look down and you're down $500. Guess what? You probably shouldn't trade for the next 5 days. To me, if you try to fight the market and get angry, the market's always going to win. And so if you violate your instruction manual or break the rules, there needs to be some sort of system of accountability. Okay, and we'll touch on all this and how to structure it and all that kind of good stuff. And last but not least, we've touched on this already, but inching towards creating a repeatable process. Okay, and that's the whole mission of doing this, because the fun analogy I always share, where I had a kid on my trading floor, back in the day. He was probably 22, 23 at the max. Ran up to me and was all excited. Sean, I just made like 8 grand in 5 minutes. And I said, well, I'm happy for you. I looked him right in the eye and I said, I need you to be able to do it again. And to me, a lot of times people don't want to take the time to do what we're sharing this evening, but those that do become profitable faster and then more successful, bar none. So, I mean, to me, that's just like anything in life. It's like, do your homework, right? And this isn't just for day trading. And that's kind of where we're separating ourselves when it comes to like Eagle Infinity. To me, this is any style of trading, whether you're a day trader or, swing trader, or like a position trader where you're going to trade for 6 months to a year. So all of these isms that we're going to share apply to that. We may cater different time frames of charts that we use, and a little bit different, trading strategies, but by and large, this is a process, again, whether you're a shorter term trader or an investor. Okay. Yes, so someone's typing in the question, is this stream going to be recorded? Yes, we are recording at this juncture right now. Okay. And so here, I don't need to read verbatim here, but it's, treating a trade, or maybe that's a way to say it, treating a transaction as if it's a business transaction. Okay. And it needs to have a clear, defined plan with outcomes, strengths, hurdles, time commitments, what the end game may be. And creating a system to define success and evaluate your progress over time is imperative. And another way to think about it is that you create this plan, you start trading or investing, and then you do an audit. And that's a fun way to think about it. And sometimes these things I I think about bigger picture, but I've been coaching people to do this since like 2001, believe it or not. So better part of 20 years I've been working with people. And the fun part is give yourself an audit, and maybe that's a good mindset that you should have. You create a system, you start trading the system, and you need to go back over and audit your system. And I can give you another corny analogy, and I don't know if anybody's ever read, there's an author by the name of Van Tharp, clinical therapist, but his entire practice has been coaching traders, or trader psychology. And I know we'll do some Eagle Infinity psychology streams as well. But in some of his writings, he said some of the traders that go from mediocre to rock star status are when they actually start running money, and even running family money, to where you're held to a higher standard. And that is exactly what we want. By creating this business plan and a document and structure, you're trying to hold yourself to a higher accountability. Because if you're just trading on your own accord, it kind of gets whimsical about, yeah, I'll put on an extra 100 shares now. Oh, I'll put on an extra 1,000 shares. I'll widen up my stop. And again, if you're more of an accountable system, then it kind of makes it very, very mechanical and very robotic. Okay. All right. So how are we doing so far? Do we understand why we're doing this? Does anybody have any comments as we go through this journey? Good. And so the way that the rest of the deck is built out is that it's built out in a very, polished deck for you, but every single slide kind of holds its own topic or chapter that should be built out in your business plan or your trade plan. Okay. And so for those of you that are taking notes, again, each slide is kind of built out so that it literally is a heading or a chapter that should be a piece in your journal and in your trade plan. Okay. All right. Forward. All right. So here's where we're going through. So these are all kind of the things that this is kind of a splash page for you. But again, these are all kind of the headings of sub chapters that need to be included in a thorough business document. And the first time I actually took the time to build my own trade plan and business document, it was about 17 pages long, if that gives you any perspective. Okay. And so here, first and foremost, I think it's imperative to identify your strengths and weaknesses. And I think it's sometimes easier for small business owners to sometimes become consistent and profitable. Because if I look at a business owner that's ran a successful small business, and I'll say, well, why aren't you successful trading and investing? And they'll say, well, I don't get it. And I'm like, well, are you successful in your small business? And the person says, well, yeah, I am. It took me a couple of years to figure it out, but I did. So those traits that drove success for you in your small business, you just need to write those down. And it's crazy how the same themes drive success in investing and trading. And the thing with a small business, you very quickly find out what you're good at, find out what you're not good at, and either you need to overcome, let's call it a personality, not a personality flaw, a personality quirk. The quicker you overcome it, the better, or find a way to outsource. Now, sometimes the trouble with trading and investing, it's hard to outsource. Okay, so again, find out what your strengths and weaknesses are. And if you do have some weaknesses, find a way to circumvent that. And sometimes for a lot of you that tend to be a little bit impulsive, let's call you out. Those of you that are a little impulsive, the best way is to put in your stop loss, your entry price, and your target price. So do a conditional order, a 3-part order, the moment you get in the trade. So in the trades, you're going to work or it's not. And so I think that sometimes the biggest thing, could be focus and or impulsiveness. Those are the two probably that can kick you, and willing to be wrong, because sometimes people don't want to use stop losses because they're trying to be right. Okay, so if you're a person that's prone to that, figure out the workaround. Okay, so we'll dive into that a little more here in just a moment. So we're going to go through a process of creating a mission statement this afternoon or this evening. We're going to be identifying your trading goals. And it sounds corny and cliche, but your trading goals need to be bigger than yourself. Like, I want to donate to charity. I want to build a church. I want to help my family. Then you're more likely to be accountable when you trade and invest. Okay. What assets are you going to be trading? Like literally what What style, what type are you trading? Stocks, futures, forex? You need to define that in your trade plan. You have to identify a trading strategy that fits you, your personality, and also your time commitment. You can afford to commit to it. Position sizing and initial risk assessment, that's imperative. So we'll actually get into position sizing, and I'll actually give you some formulas as well. Okay. Understanding R multiples. I don't know if anybody has sat you down and explained risk reward ratios, but we'll talk about that as well. Establishing a daily routine. And it's amazing to me how many people do not create office hours to function in for investing and trading. Okay. And it's not just office hours, seat time actually transacting. It's also office hours for furthering your knowledge. Okay. That all needs to be defined. Perform a review process on your trades. And first and foremost, it'll probably be a daily process when you first start. Then it might be a end of the week process. Then it may be a monthly and then a quarterly process. Okay. And to give you some foundation, anytime I've sat down and spent like, 3 or 4 hours reviewing the past 6 months of transactions, I always have some takeaways to where, I just noticed this, where I'll switch up how I transact going forward when I've spent the time to look at the transactions that I've been doing the past 3 to 6 months. If that makes any sense. Education plan. How are you going to grow? What's going to drive the needle for you? And I have some stories working with people. I have some stories that are personal to me too. So we'll share some of that. All right. So let's dive into this. So the premise is, why am I doing this? Okay. And, it's funny that I, I guess I have a different perspective because running a trading floor, sometimes I would walk by traders that I could see that were over trading, trading just to sake to trade. And it's amazing to me how many traders I bumped into that are transacting and trading because they're bored. And so it sounds funny that, um, to me, it's like find a way to entertain yourself other than needing to be in a trade. So I got isms for days that I'll be sharing as we progress and do these infinity streams. But yeah, find a way to entertain yourself other than needing to be in a trade. Okay. And you can see the slide that says, we need to create a mission statement. And so for any of you that have ever, had a small business, or for instance, went to like SBA, the Small Business Association, and tried to get a small business loan, or go to a bank to get some funding to create a small business, the first thing out their mouth is, what do you have for collateral, right? The second thing out their mouth is, let me see your business plan. And normally you can pay all kinds of money to have somebody professionally prepare a business plan for you. But to me, I'm literally hand-holding you this evening on what to build out and what to look at and how to treat your trade like a business this evening. Okay, so that's where we're breaking apart as we progress. But here, establishing a mission statement, and you heard me say it needs to be bigger than thyself. So you can't say, I want to make money. I want to make money. I want to, fire my boss. Even that is kind of a little bit on the selfish side. So usually it's suggested that your mission statement is bigger than yourself. And the fun mission statement to share is Apple. I don't know if anybody in this room knows Apple's mission statement. And this was back in the day. And it's a pretty simple business plan, but it's amazing the track record that they had doing it. I don't know if anybody knows, but Apple's business plan was to create groundbreaking technology products that change consumer habits. And if you think about it, they've done it, I don't know, at least a half a dozen times. The iPhone, iPad, the Apple TV. What else have they done? So to me, they've had the Macintosh like back in the day. So they've had a pretty good track record of doing that. And so the mission statement normally can't be just to make money. It's like, I want to put my grandkids through college, and you don't even have any kids yet. I want 3 generations of wealth so I can educate, 3 or 4 downlines of generations. or I want to donate to charity, I want to build a church. So, and there's a lot of research to this where if your mission statement is bigger than yourself, you're more inclined to follow the rules, to be disciplined, to go back over and review your trades to try to get better, to commit the time. Okay. Hopefully this is making sense where, again, it needs to be bigger than yourself. For me, if you want to know, selfish, it's generational giving. Not just giving money to, my grandkids, but like, helping them make their lives easier, mainly for educational purposes. So to me, there's all kinds of fun things you can do with trusts where you could actually gift to your heirs, but it's strictly for educational purposes, and you can structure your trust that way. So something to think about. Okay. All right. And so moving on. And so, up at the top, it says, what are my strengths and weaknesses as an investor or trader? And, I don't need the altruistic you. I need the humble pie you. And, I could share some things about me. I am a big picture thinker. I'm thinking 30 years down the road, but sometimes I hate the details. And, the details kind of got the best of me when I first started. And I had to journal, I had to be accountable and deal with the details to get consistent. And so, I'm a patient person as well. I know that about myself. Discipline was hard for me when I first started. Discipline had to be beaten into me. And maybe my parents were too soft on me when I was, being raised. But discipline was hard for me. And what finally made me, get over the fence was, does this habit pay me? Does this habit cause me to lose money? So when I wasn't disciplined, I would lose money, which falls into that category. Does this habit cause me to make money? Does this habit cause me to, lose money? And, that's a simple premise. And, it's just something to think about bigger picture. And the interesting thing is doing this as long as I have, you strangely, once you start to get consistent and start exemplifying good habits, you'll look back to the way you traded before and go, why did I ever trade that way? Or why did I ever invest that way? Okay. And so these are all things to consider. Okay. And then down here, the second bullet point, are there some, what should we call them? We're not going to call them flaws. Let's call them personality quirks. um, to me, that's definitely something to consider, right? And so, just food for thought, right? Going back to strengths, like what are you a person that has some stick-to-itiveness? Can you be a listener? And sometimes even the expression, are you coachable? That's another one that comes up quite a bit when it comes to trading and investing. Okay. Can you focus? Or do you have a strong ability to focus on a particular task until you drive success? Okay. So here, hurdles, no discipline, indecisive, not a good listener, impatient, no goals, no in-game insight, you procrastinate. This game is interesting because it's too easy to click the button. If you jump into a trade, it is too easy just to hit the button and jump in. So that kind of creates a natural problem when it comes to investing and trading, right? And the unfun stuff, the accountability, right, is the unfun stuff. Creating a business plan, journaling, tracking your trades, reviewing your trades, all that stuff could be lumped into homework. And I always love to tell people, if someone sits down with me to start to work with me, I always tell them, you got to journal for at least the 6 months. You got to create a business plan, you got to track your trades and analyze your data for at least 6 months. And if you're not consistent yet, you can't stop. Okay. And the side bullet point over here, what are the systems that you're going to put in place to overcome What are the systems that you're going to put in place to overcome your hurdles? You know, what if you have a hard time focusing? And, you know, there's lots of things to that. It's like, I can't tell you what my focus is like if I jump on the treadmill, right, and then sit down to focus on something that I really need to pay attention to. You know, so I'm sure, you know, being an adult, you've gone through a journey to figure out, you know, what are some of the best ways for you to pay attention. And we can get cheesy and corny. You know, classical music, does that help you focus better? Like, I think you need to know thyself, and I think you need to do an accountability of yourself and find out what helps you focus. And you know, I could backtrack a little bit, but I didn't create a slide for it. But there are three separate learning styles. There's visual, there's auditory, and there's also kinesthetic. You know, I think visual is the most common. Auditory learners are the second. The third one are the kinesthetic, and they're the rarest. And that's like the hands-on type person where, and it's strangely like if I'm teaching you something, I'm supposed to like touch you on the shoulder and then you'll remember exactly what I said. And so, you know, if those of you that gone through school, gone through college, gone through, you know, graduate degrees and things like that, I think you figure out how to focus and how to learn. Okay. And so all I care is just whatever discipline that, you know, whatever learning style you are, you need to tap into that. Okay. And especially when it comes to being accountable and disciplined. Okay. Anything else I want to mention here? Yeah, for me, discipline was hard to where I struggle with discipline. And my inner voice, what I wrote, actually wrote that in my business plan. Does this habit cause me to lose money? Does this habit cause me to make money? And the faster you just stop it, the closer you are to driving towards success. Okay. Yeah, cool. And procrastination, that's probably, I'm guilty of that myself a little bit. And all I did was create office hours and that fixed me. So just sit down and create office hours weekly for yourself. Okay. And that was one way that no matter what, at this time, I would commit this much effort on this day, no matter what. And that's how I figured out, just for instance, like trading options. You know, believe it or not, options weren't intuitive for me. The concepts weren't that bad when I was first starting, but the jargon, the lingo, I got hung up on the lingo when I was a wee lad learning options for the first time. Um, you know, it wasn't so much the concept, but it was more the jargon, the lingo, the words to describe the various option strategies. And I had a hard time with it. And so for me, I said, it's been too long to figure this out. I'm creating office hours for myself weekly till I figured, you know, the light bulbs finally came on for me. Okay. Um, so Gary's asking, how did I work on the discipline? And it's two things, Gary. It's a two-parter, and we'll touch on it in this session to where my inner. So some of these things sound corny and cliche, Gary, but it's amazing how many people I've helped over the years, including myself. Okay, and the first and foremost is my inner voice. You know, whatever whatever, you know, voice you got in your head. And I literally tell myself that, does this habit cause me to make money? Does this habit cause me to lose money? And in the beginning, you may be all over the place, and you may, to be honest, I know people that really don't know what habit they're doing that's causing them to lose money. And so we'll talk about journaling here and tracking your trades, and the data tells you phenomenal things. And so once you have, I'd say 20 to 30 transactions underneath you, then you have a sample size to start pulling data. And so not only do you have that inner voice in your head, but then you're applying that concept to your transactions as you're looking through them: winners and losers, length of hold, duration, batting average, ticker selection. We'll talk about all these things in just a moment here, but hopefully that's making sense, Gary. So it's not just saying it in your voice, but it's now quantifying the data once you have a sample size. And then again, the light bulb will finally come on for you, and then it'll all of a sudden get painful to step outside the box, if that makes any sense. Because then you'll realize, you're like, oh, this bad habit causes me to lose money. The past 4 trades I've done this habit, it's lost me money. you know, at some point you're going to get to a point where you're not going to touch the hot stove. If that makes any sense, Gary. You know, there's two types of people in this world: the people that touch the hot stove. There's people that don't touch the hot stove, right? And you know which one you are. And you know, anyway. And maybe I could overshare, but I was like, I think I was 3 years old where I pulled a pot of coffee off a counter on top of me. So maybe that tells you which one I am. Anyway, food for thought, right? Yeah, and hold tight, Gary. We're gonna go pretty deep with it. We'll touch on it today, and then hopefully you can jump in on the Wednesday session. And by the way, my Wednesday session on journaling is going to be a little bit earlier, so keep an eye on the calendar for the next Infinity Stream. Okay, absolutely. So we're going to go in depth. So we're going to touch you and tease it a little bit in this session, Gary, but then we're going to do a deep dive in regards to journaling. And for me, you know, I have a different perspective than most because I've actually ran traders on a trading floor. Okay. All right, moving on. So here, this is something that sometimes people need me to quantify. Okay, and I think depending on what type of brain you are, some people are more detail oriented, some people are more abstract thinkers. And I think the best way to describe it is, if you don't mind, I'll discuss day trading. And that could apply, you know, to swing traders where you're holding over several days, or position traders. But let's just use the analogy of, for instance, maybe a day trader. And, you know, to rewind and, you know, kind of give you a day in the life back in the day on, you know, a day trading floor, a stock trading floor, 20-to-1 leverage back in the day on stocks. Okay, again, we were licensed trading floors, so we swung big bets, 20-to-1 leverage. But compartmentalizing it, let's say that you have doesn't really matter, but when I would hire a brand new trader off the street and I'd start training them, trying to build them up to, you know, become a trader, usually we suggested, you know, stocks that traded between $20 and $50 a share. So this is also something you need to define in this trade plan. You have to kind of define what assets you're trading and how expensive those assets are. Okay, and so let's say that you're trying to make, doesn't really matter, but let's use $100,000. Let's say you want to try to eventually get to that point where you can make $100,000 a year trading. Okay, and so let's say we're using the example, and we started traders off, I'm kid you not, at usually picking stocks between 20 to 50 bucks a share. And let's say that those stocks moved $1 a day. And what I always used to work with people is, your mission is to scrape out 10 to 50 cents a share, maybe actually 20 to 50 cents a share per day. Because eventually, if you're swinging 1,000 shares of stock, capturing a 20-cent move, okay, that's a $200 day for you. And if there's 250 trading days in a year, okay, we're talking probably $45,000, $50,000, $60,000. Okay, now if that is not going to, you're like, Sean, that's not even going to pay my electric bill. I got you. The world's expensive now. Okay, well then, you know, you're not going to necessarily shoot for a bigger profit target. And this is another thing we'll get to today, but it's actually a little bit larger bet. Now, you don't start off trading 2,000 shares, but all of a sudden, if you're trading 2,000 shares and you're making 20 cents per share per day, okay, trading, all of a sudden that's $100,000 because there's 250 trading days in a year. So hopefully this is making sense, and it's amazing to me how many people don't compartmentalize it, or they're more of an abstract thinker and they can't compartmentalize it. So then the talk track is trade stocks between 20 to 50 bucks a share, try to scrape out 20 cents per share per day times a couple thousand shares. Believe it or not, in no time you'll be hitting your goal. Okay, now you don't start off trading 2,000 shares. You might start off trading 200 shares. It's not about the money in the beginning, it's about the consistency. Okay, now one last little thing. does the 20 cents per share have to be one trade? That's the beauty of it. It can be a nickel per ticker. What if you do 4 trades that day and 3 of them you make 21 cents, one of them you lose like a nickel on, but net you're pretty close to making 20 cents that day. So again, it doesn't have to be one transaction. It can be multiple transactions. As long as the end of the day net you're up 20 cents a share, maybe after commissions, right? And so if you think about it that way, all of a sudden the stress load reduces. You're like, wait, all I needed to get is 20 cents a share total per day can actually possibly be a living for me? The answer is yes, right? And again, you don't start trading 2,000 shares, you work up to that. And so when you're building this out, you start off what your annual kind of goal would be, not your altruistic, like I want to buy Ferraris and jets. No, first step, baby steps. What's the first goal that you're trying to achieve? And then you compartmentalize it monthly, then you compartmentalize it weekly, then daily, and then quantify what asset that you're trading on, how much the asset moves in a day, and then you very quickly find out to what quantity that you need to trade to reach your goals. Okay, and I don't know if anybody's ever laid this out for the people that are attending this evening, but that's how I've always broken it down for people to compartmentalize it, whether they're day traders, whether they're swing traders, whether they're position traders. Okay. Yeah, I mean, to me, define it, write it down. Okay. It's amazing, like statistics, like you're so much more likely to achieve it if you just at least write it down. You know what I mean? There's a lot of research to that. Write it down. Yeah, that's where that book, The Secret. I don't know if anybody's read that book or watched the movie, and that's essentially what you do. I mean, you're visualizing your goals. Okay. And all I care is be specific. So people that have handed me a business plan or a trade plan to review, that's usually what I chalk full, detail, to where they say, yeah, I want to make 100 grand a year. I'm like, well, okay, but what's that monthly? What's that weekly? What's that in a day? And then what asset? And then how much does that asset move? And is that realistic? Because another thing, if you focus on stocks, for instance, that are 20 to 50 bucks a share, and they move average of $1 a day, statistically, is it plausible that you may be able to get 20 cents out of that stock in a given day on one particular move intraday, or a particular move in a week's time, whatever it may be on if you're a day trader or swing trader, for instance. So it also has to be the candidate selection. That's also vital. So it's not just defining the goals, but then it's picking an asset, but then tickers within that asset class, like futures, options, stocks, Forex, that have a chance of moving enough to reach your goal. For instance, if you're trading, let's use an example. What's a mover? Cliff is one that comes to mind. CLF is a mover, but could you trade Budweiser instead, BUD? The Cliff, it's a much faster heart rate. You could trade Budweiser, but it's a lot slower mover. It's still okay to maybe trade Budweiser, but you might need to swing it with a bigger bat to still try to get your in-game goal that you're looking for. Okay, so I threw all that at you just now. Is this making sense, everybody? Does anybody have any questions, and did you like it broken down that way? Talk to me. Don't be bashful. A couple of you are typing in here. It's amazing to me how many people I've worked with that have never quantified it. Right. And it's funny, Jay, that believe it or not, smaller goals is usually where it's at, because to me, I can't tell you how many people I've pushed to profitability over the years, just encouraging them to have smaller targets and then slowly increasing your position sizing. Okay. Yeah, I mean, I've been there, done that. I've coached a lot of people over the years. Okay. All right, moving on. So here, what assets are you going to be trading? And it's amazing to me how many people do 3, 4, 10 transactions stop trading, switch up strategies, switch assets. They're all over the place. And to me, it never drives consistency. In fact, I can't think of someone that could hold it down for long staying power, where they could just hop all over the place, trading stocks, options, futures, forex, and just still crush it. Because usually they'll get consistent in one, they'll go trade the other one, lose money, and then go back to the one that's consistent. In my experience over the years. And so I love the expression, pick one. I love the expression master a few. And also, to me, you need to stick with it. And before you switch gears, either a different strategy or different assets or different tickers, it may be suggested, or I'm not going to suggest, I'm going to highly encourage or sit on you and basically keep trading the same asset class, whether it's stock, forex, futures, or options, or even crypto, until you at least have 20 to 30 transactions underneath your belt. Okay. And for those of you that don't want to commit real money to it, could you be on a simulator? Yes, you could. But yeah, it's amazing. You got to stick with the same style. Let's just call it style. I mean, to me, you got the same assets, same strategy for at least 20 to 30 transactions before you ever consider switching on to something else. Because a lot of people, you have 3 loses in a row, you're stopped out 3 times, you're moving on. Okay, so cut it out. To me in science, you need at least 100 samples before you're making any conclusions. I'm not saying you need 100 trades, but yeah, I love the analogy of a quarter. Could you flip a quarter, 100 times, and there may be 10 times where that damn quarter, comes up heads, makes you angry, but the statistics support that. And so, yeah, could you have 3, 4, 5 losers in a row? Yes, but then you may have 3, 4, 5 winners in a row. Right? And in the end, net, it should wash out. And so before you're asking yourself, to Gary's point, consistency, does this habit make me money? Does this habit lose money? But you can't do it on 3 trades. You're asking yourself those questions on probably a sample size. Some people say 20. I personally like 30. And there's been many times where I've had inconsistent traders sit with me. And that's the thing I'm asking for. Let me see your trade journal. Let me see your transactions over the past 6 months. And that's usually what I ask for when I sit with someone. And, sometimes it's like 10 minutes that I can figure out what they're doing that they could improve on. There's been other times where it take a solid like 45 minutes, before I finally figured out what this person was doing and how I could inch them to drive to more consistency and or profitability. Okay. All right, moving on. Let me see, there's a comment here. A lot of mindsets trading around swinging for the fences. Have made a fortune. Okay, small accounts looking at 1 penny stock go from 1 cent to 5.15. Sparta. And so I get you. And the funny part is that sometimes you hear somebody, oh, so and so did this trade and they made enough to retire on. Okay, that may be true. But what you don't hear is that person's been trading for the past 10, 15, 20 years before they had that one trade that allowed them to be retired, or they have that one trade that they make a fortune on, but then they give it back to the market. You know what I mean? And so the old ism is, it's not about making money, it's about keeping money. First battle's to make money, then in the battle's to keep it. And I think Sparta, I think in the beginning, when you're learning, should you try to be swing for the fences, or when you're learning, you should be focused on more how to make it a repeatable process. You know what I'm saying? Or at least until you get the knowledge and expertise, and then you'll know when an opportunity comes, and you could hit with a larger bat. And to me, my suggestion isn't, trying to hit a home run. It's not my suggestion. My suggestion is base hits and slowly increasing your position size, so then slowly you're making more and more money. Because I've been doing this a long time, and by and large, people that are base hitters and hit doubles occasionally, with slowly increasing your position sizing, are the people that are still in the game, that are still successful, and we're able to keep their money. Okay. And it's not about making bigger and bigger moves. It's about same moves, whether you're trading 200 shares or 10,000 shares. It's usually the same moves, just slowly start increasing your position sizing. So then you're effectively making more money, right? And you're not necessarily trying to get a bigger move. Because anytime you're trying to get a bigger move in a stock or option or futures or whatever asset that you're trading, statistically, it's harder to have that bigger move. And that's what we want. We want to drive the consistency through the roof. That's what you want to drive towards. Okay, so I'm preachy. I got you. Hopefully this helps, Sparta. So here, goals. And this is something that I also help people is that you need to compartmentalize. So like I have a different chapter in my business plan for the way I trade like my retirement monies or savings account monies. I have a different chapter in my business plan to where I'm more active trading. Dominantly, I still swing trade. Majority of the time, I'm a swing trader. Occasionally, I day trade, but that's just if I hit target same day. But that's also built out of my business plan. So I even go as far as to have separate accounts so that it's like a physical like switch over or log out, log back in. So I have a mindset, oh, this is my retirement account. I'm not going to go do something crazy because it's my retirement money and I need to trade my retirement assets this certain way. So it's style. So you can creepily trade a similar style, but you might do it a little bit more conservatively in a retirement account. You know what I mean? And that sometimes can be just switching tickers. You might do an index in your retirement to sell options on, but you may go trade, the crazies, the Pelotons, the AMDs, the fast movers for shorter term income. You know what I mean? And so, compartmentalize your accounts and also how much capital needs to be written into your trade plan. Where it's like, I'm going to start my active trading account with 3 grand. Meanwhile, I have, a couple $100,000 in my retirement account, whatever that may be. And then here's how I'm going to trade each unit of capital or each account. And then what's the risk components for each account. Okay. Hope that makes sense. So compartmentalize, like that's with your accounts, and then your trading styles also need to be compartmentalized because normally you don't trade your retirement the same way you trade your day trading account or your weekly income account. Okay. So a question's coming in. How can I maximize gains on holding trending stocks and industries? For example, I had a USO option at $1.10, sold them for $3.40. Subsequent moved up over 10 each now and expires 3/18. Should have held for more move. Yeah, so that's kind of a more kind of in the trenches or very finite, example there. But there's a couple things. And this is a business that you can't wet noodle yourself. The woulda, coulda, shouldas. That's going to drive you bonkers. And that may be, you might be pointing out a little part of your personality as well. The game is to let your winners run. But there are times where, you're like, crud, I got out, but I could have made more. And, to be fair, you almost have a factor of 3 or a 300% gain there. So you can't cry over what you ended up with, because the whole ism is that you don't know if it's going to keep going, because it just as easily could have been, a full loss for you. You know what I mean? So like it takes perspective, and there are some things that we can implement. Like for instance, I'm a big moving average guy. A moving average on a little bit smaller time frame sometimes can assist you in letting your winners run. So there are very finite things you can do, Sparta, to implement if that bugs you that much. But I think you did okay on the deal. You know what I mean? And sometimes I push back on people where they're like, yeah, I got out too soon. But it's like, well, wait, what was your goal at the time you got into the trade, and did you meet that goal? So sometimes it takes time and level set. And for every trade that you didn't squeeze all the juice out of that lemon, you'll catch 2 or 3 others that you do, and then you pat yourself on the back. So it's like, normally these things are defined at the moment you're getting into the trade, not, in the life. And so if it bugs you that much, then you're saying, okay, what are my takeaways? What could I do differently next time? And a simple suggestion is, there are smaller time moving averages that you could apply to kind of calm your nerves to try and let your winners run a little longer. At least that's a strategy that I've implemented myself over the years. Okay. All right. Cool. So moving forward. All right. So this is kind of important to me as a coach, as a trader myself, and I couldn't get consistent until I slowed down a little bit. That's a true story. I used to do 200 transactions a day. I can repeat that. 200 transactions a day. Woo, Energizer Bunny. That used to be me. And I probably do 3 to 5 trades a week now. Surprising for people to hear that. And there's some story behind it, and there's a mentor behind it, and a coach behind it that worked with me. A lot of things, including my personality. And to me, I've come to the point where a little bit bigger time frames the levels tend to hold. Like, we're very specifically talking about support or resistance. And I'm going to drop the seed. You guys and gals can go do your homework, but usually the bigger time frame levels tend to hold a little bit better. And I might be the first person ever sharing this to you. And to me, it's all trust but verify. Go look. But for instance, first and foremost, in your trade plan, you have to define the time frames that you're using and stick with those time frames to that original ism of 20 to 30 transactions, same time frames of charts that you're using for your levels. Okay, don't amend your time frames that you're charting until you at least have 20 to 30 transactions under your belt of the same time frames. And just as an ism, a teaser that I'll throw out there is that there are times where, let's say, a daily support level versus a 5-minute support level. I don't know if you've ever had to where a level was blown through and the stock went lower, for instance. Let's just say it's a support level and you're buying a call. I don't know if you ever had a level blow through on like a 5-minute chart. For instance, if you drew the level closer to the daily support level, magically those levels tend to respect a little bit better and hold better. Okay, and an ism I could throw out to you, just something to consider: could you use a daily chart but still day trade, but then only trade that ticker when it gets down to the daily level intraday? It may not happen every day, but it may happen twice a week where it touches a daily level intraday, then trade it even if it's still a day trade. So food for thought. And so, believe it or not, sometimes the time frames of charts that I've helped people over the years makes a huge impact. It did for me. I was Mr. 1-minute chart when I first started, and when I started using bigger time frames, life was better. For instance, you could even use a 4-hour chart to day trade. You just have to be a little bit more patient till it comes to the 4-hour zone before you day trade it. But it kind of switches you up a little bit. And I've specifically, like, more volatile things. Like, if you're a futures trader, oh my goodness, I've worked with many people slowing them down and using a little bit bigger time frames and being more patient. And all of a sudden I get big old flowery emails in my inbox. Okay, so these are things to consider. And I'm throwing more kind of epiphanies at you, I guess, but you need to be aware. And at least in the beginning, what I may suggest is it's okay to use a 5-minute chart and do a bunch of transactions, but then you may look at a 5-hour or like a 4-hour chart and do a bunch of transactions using 4-hour zones, and then see which one has a better batting average. Catch my drift? Okay, so it's vital you're keeping track of what you're using. And I know a bunch of you have been in my streams in the past. I usually use weekly for trend and daily for strike selection. Maybe go down to a 4-hour for refinement, but by and large, I'm weekly for trend and daily for levels or strike selection. And I've been that way for like 15 years. Okay, but that's all because I've done the time. I know what works for me. Okay. So anyway, in the beginning, start a plan. Give yourself a guide what time frames you're going to be using. Defining the strategy, and this is vital. And what I've done over the years, me personally, I've done screenshots and snippets and print screen and print out the chart and the strategy that I did for this trade, 3-hole punch it and put it in my binder to keep track. And then the next time I do it, I may just see how many times it works implementing that specific strategy. So we can talk about strategies for days. We can talk about debit versus credit option trades. We can talk about breakout trading. You know, it moves up and it's breaking a high, you jump in. We can talk about regression trading, where you find an uptrending stock and you wait for a pullback and then you look for a re-entry to still go long. That's more my style. I'm a regression style trader. Okay, and I'm also a candle guy. I'm also a moving average guy. All these things are tools that I brought in, which encompasses my entire style of trading. Okay, which includes the weekly for trend, which includes the daily for my strike selection. I am dominantly a regression, respecting trend, waiting for the pullback, look for re-entry. You know, an up versus down day and timing my premium. And some of you have seen me do that as well. All that's defined in my business plan. And detail, detail, detail. Like here, it says define strategy, define setups, define rules for entry, define rules for exit. All that has to be predetermined and defined. Same thing there. Once you've defined all this, then you need that 20 to 30 transactions before you switch gears. Again, all this stuff is how to create a system so it is repeatable. You make a bunch of money, I'm going to look you right in the eye and say, I need to see you do it again and again and again, right? And again, this is, I say again, this process people don't want to do, but the faster you get over it, the faster you implement it, the better you'll be. And, you know, if I were to talk about two career choices, I've worked with, I don't know, I can't count that high. I bet I've worked with probably 40, maybe 50 doctors. I've probably worked with 15 pilots. Fewer pilots I've worked with, surprisingly. But surprisingly, pilots I've seen get consistent faster, because you tell the pilot to create a checklist, right? They do it. Before you put an airplane in the air, they have to run through this checklist. It's not work, it's not, they just do it. You tell them to make, because if I run into a pilot that's not consistent, I'm like, buddy, where's your checklist? And sure enough, they're like, oh, I need a checklist, don't I? Before every trade. I'm like, yep. And as soon as they start implementing that, it's amazing. Then they just clicks, right? Doctors want to be right all the time. They're used to being right, because if they're wrong, people die. Doctors, you know, there's like, I think there's an ego thing sometimes with doctors. Maybe that could be, but it's just like, you know, to me, it's okay to be wrong in this business. You can survive in this business only being right 30% of the time. If you're running like a 1-to-3 ratio, cut your losers, let your winners run, you still can survive with only being right 30% of the time. Okay, so doctors sometimes have a hard time wrapping their brain around that, because they're used to just always needing to be right. Well, you don't need to be right all the time. You just need to manage your risk. Okay. All right. Moving on. So is this making sense, everybody? And you know, this is kind of a generic slide. I get you on that, but like, you know, you want to spell out the candle formations that you're looking for. You want to define the pullback. You want to define the breakout on what time frame it charts. Are you encompassing moving average? Are you respecting trend? All these things need to be listed out that you're implementing, that need to be present before you're going to put on a trade. Okay, and sometimes I've worked with people where I'm like, okay, just create a checklist that sits next to your keyboard and just run check boxes down the list before you put on the trade. Okay, and implementing this type of stuff slowed me down. I went from like 200 transactions a day down to probably 20, you know, almost overnight, when I actually had to start defining all this and then being quantifiable and repeatable. So here, you know, I was mentioning a little bit to, you know, Sparta in here, and it's amazing to me. People don't define their stop entry target prior to entry. You know, you don't ask yourself, okay, am I willing to lose, you know, what's my entry price? I'm going to jump in. Let's say the stock's 50 bucks. Okay, I'm going to jump in at 50 bucks. My stop loss is 49, so I'm willing to lose $1 a share. Okay, if I'm trading 100 shares, I lose 100 bucks per 100 shares. But my target might be, you know, 2, 3, or 4, 5 to 1. So I'm trying to risk 100 bucks, but I might be trying to make 200 bucks, or risk $100 trying to make $300. So all that needs to be defined upon entry, and then put the order in, especially those that aren't as disciplined as you would like. You know, you got to put a stop loss in, you got to put an entry price, and you got to put a target. So they're called conditional orders, and you can put a stop, entry, target for the most part on most asset classes that you trade. And so do it, right? We'll talk about risk reward ratios in just a moment. And we can talk about, you know, Stephen Covey, is it 7 Habits of Highly Effective People, and there's self-destructive behavior you can exhibit. That might be not using a stop loss. So food for thought. You know, to me, it's like, well, just be careful, because preservation of capital. If you blow up your account, you have to stop trading. I can say that one more time. If you blow up your account, you have to stop trading. And you know, it's like, you know, fast food restaurant, you sell French fries. Well, the money you make off French fries, if you don't buy more inventory, you can't keep selling French fries. So all the more reason to manage your risk and have stop losses on your transactions. Okay. If you don't use stop losses, could you have offset trades? Like, you know, if you go long calls or long shares, could you purchase puts as insurance? So that's kind of, you know, in lieu of a stop loss. So risk to reward ratios, and some authors call it, you know, RR multiples, and 1 unit of risk, 2 units of reward, or 1 unit of risk, 3 units of reward. Could you do 1 unit of risk, 1 unit of reward? So let's say you're trying to make $100. Could you stop yourself out at $100, or if you make $100 or $1 a share, you'll get out? That's a 1-to-1. I don't suggest implementing 1-to-1s unless your batting average is north of 50%, because then it makes sense and you can afford 1-to-1s. Otherwise, most people can't. So if your batting average is 50%, yeah, you should at least shoot for 2-to-1 or be willing to be stopped out. Okay. So the next bullet point here, position size of the risk stays the same. And this is an interesting one where you can actually define, you know, so let's say you have a, you know, it doesn't really matter, a $10,000 account. And if you're willing to risk, I don't know, 2% of the $10,000 account, what would that be? A couple $100, right? And so could you take a couple $100 as your max risk per transaction? And the old ism is, let's say you did have a $200 risk on every trade, you know, is it going to take a while before you blow up your $10,000 account? Does that make sense? So you got to define it. And the old isms are 1/4% upwards of 2%. And some people argue don't risk more than 2% per transaction. And some of this is old school money manager type stuff. Don't risk more than 2% in any one transaction. And that's usually for position trading. Like you're going to be in it for a couple months or a year. So 1/4 to 0.5% risk per transaction is suggested actually for day trading. 1% risk per transaction. This is where you're stopped out at, right? 1% of the account for like swing trading, where you're going to be in it for 3 days. Okay, and I can repeat those one more time. 1/4 to 0.5% risk per transaction for day trading. 1% for swing trading, 2% for position trading, or like longer term trading. And these are old school conservative isms, you know, because if I use, let's say 100 grand, like let's say you got a $100,000 account, you're using a 1% model, that affords you 100 trades all in a row before you blow up the account. A broken clock is right twice a day. You're not going to have 100 losers in a row. Okay, trust me. Okay, so that these are fairly conservative isms. Okay, you know, something definitely to consider. Okay, and can you take your kind of maximum risk amount, believe it or not, and divide it by the risk on the trade? Believe it or not, where the movement of the stock might stop out. So if the stock drops 50 cents, you can actually divide 50 cents into, let's say, your $200, and it'll spit out how many shares to actually purchase. So there's some formulas that we can touch on, but there's formulas you can actually use to assist you with position sizing. I don't know if you've ever seen that. So basically you take the max risk per trade and divide it by the wiggle that doesn't make you feel good in the stock. Let's say it drops 50 cents. You divide the $200 by the 50 cents. It'll give you a figure on how many shares to actually transact. And so I don't know if you've ever read that in any books, but there you can actually use the max risk divided by the stock wiggle, and that you don't want to happen, and it'll actually spit out how many shares to buy. Kind of fun. Okay. So let me see what is coming in the chat. So Sparta's asking, how much can you ask of a $100,000 account, $500 account, $1 million account? Can you basically ask $100,000 to create $100,000 annually? Yes, Sparta. I don't know if you jumped in late, but taking it back to when I had the trading floor, $20 to $50 stocks, moving 20 cents to $1 a day. If you try to get 20 cents per share per day, right, that would equate to essentially $100,000 if you're doing 1,000 to 2,000 shares per transaction, scraping out 20 cents per day. So the whole thing is just compartmentalize it, Sparta. And, is it plausible? Yeah, as long as you can scrape out the 20 cents per share per day. The cool thing about that is that you doesn't have to be one transaction. The caveat is, do you need to be a consistent trader? The answer is yes, Sparta. Do you need to manage your risk? Do you need to be applying everything we're discussing? The answer is yes. Okay, so first you find the goals that you need, then you have to create a system that drives consistency for you to achieve those goals. Okay, so it's not just defining the goal, then you need to create a system that you're consistent with to get to that, perspective. Okay, so a lot of people don't compartmentalize it, so compartmentalize it. Okay. So here, we've touched on some of these already. Do you want to not use stop losses? Well, you don't have to use stop losses, but it might be self-destructive behavior. And the beauty of it is you don't need to be right. Cut your losers, let your winners run. Okay, define profit and loss multiples on your initial risk. And like I say, you need to define it. And that's another one people don't define. So let's say I have a $10,000 account. Let's back up. If you lose $100 today, if I literally take a $100 bill of yours and light it on fire, if you're going to have trouble sleeping tonight, guess what we've just defined for you? If the same token, if I take $1,000, because people are like, I spent $100 on a bottle of wine last night. Okay, fine. If I take, $1,000 and I light it on fire, are you going to have trouble sleeping this evening? Okay, so very quickly you can define what your risk may be. Write it down. And normally that's kind of your max risk per day. Whether it's $100 for you or $1,000, you define it and don't exceed that in your transactions. Okay. Hopefully the 1 to 2, 1 to 3 multiple risk toward ratio makes sense. I personally have helped many people that were shooting for a 1 to 3, 1 to 4, 1 to 5, 10 to 1 profits. And their batting averages were like 30, 40% when they were shooting for these big goals in the transaction. And sitting with them, I've actually had people know their percentage on the 2 to 1. So the way to say this eloquently, of the trades that you were stopped out on, would they have at least reached a 2 to 1? Where it's like you're risking 10 cents to make 30 cents. How many of the trades that you were shooting for 30 or 40 or 50 cents, only risking 10 cents, would have reached a 2 to 1? And it's amazing. I've worked with so many people just telling them to stop shooting for 3, 4, 5 to 1s, start shooting for 2 to 1s. And all of a sudden their batting average shoots into the 60, 70 percentile, shoving them into profitability. I can't even count it on my hands and toes on how many people I've encouraged to run smaller targets, and all of a sudden they shove themselves into profitability and consistency. Okay, so food for thought. And so again, you may not be the big target person or visit bigger targets later in your career. For right now, I think the most important thing is to get consistent, right? So hopefully that makes sense. And again, this is me coaching people over the years. So hopefully you take it to heart. This is a fun one. Never risk a certain percentage for the entire account with multiple positions. And that's something to consider. Some people suggest no more than 10% risk on the whole account. So if you're in multiple trades, they're all stopped out, you won't lose more than 10% of the account. When, let's say you have 5 trades running right now, you're in 5 trades, all of them stop out, you shouldn't lose more than like 10% of the account value. Okay, and that one there, I'm sure a lot of you don't adhere to that. Okay, so that's definitely that's an old school ism, and that 10% actually is applied to even like retirement accounts, believe it or not. They talk about portfolio risk, right? And it's amazing to me how many people are overexposed. Especially when the stock market drops 30%, people lose 30% of their account, and it's either because they don't have an offset trade for insurance or they don't have stop losses, and then they pray that the market comes back and they recover. Okay. And last but not least, we can dive in this, diversification, and some of that is inverse correlated stuff. A good example would be the stock market versus the yen, or the stock market versus bonds, the stock market versus gold. Those are, there's some diversification right there. Right now, the irony is retail stocks compared against oil stocks. When the market keeps going down, 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 oil stocks keep going up, up, up. So at the moment, are they inverse? To a large extent, the answer is yes. Okay. All right, make it mechanical. And writing down, have a predefined stop entry target is how to make it mechanical because it eliminates emotion. We need to get rid of the emotion. You should not be happy or sad when you trade. It's just next, it's a transaction, moving on. And the hard part, put the passion into your next trade, not the passion in the trade that you're in right now, is monumental. So journaling. So we're actually going to talk about journaling more extensively on Wednesday, but this is in my opinion, one of the golden secrets to trading. I could show you this strategies, but you got to combine it with the risk management, the money management, and then the trade tracking. So here, learn a lesson from every trade. Otherwise, it's a waste of your time. That's not a Sean original. That was handed down to me by one of my mentors. So learn a lesson from every trade. Otherwise, it's a waste of your time. Why did you place the trade? Why did you get out of the trade? What would you do differently next time? Did you like the way it turned out? I want to get touchy-feely on the trade. No new transactions until you just reflect on one you just completed. This one alone slowed me down by 75% when I was a hyperactive trader in my youth. Okay, no new transactions until you've reflected on all this stuff from the transaction you just completed. You need to stop having the fear that you're missing something. Stop it. It's more important to get, consistent than trying to hit the sexiest trade today. If that make any sense? And sometimes it takes time to be confident in that, to where, I had a friend, a colleague that said there's a trade of a lifetime right around the corner. So don't worry about it. Learn a lesson from every trade, and don't do a new transaction until you've journaled, reflected on the one you just completed. Okay, and we're going to spend quite a bit of time on this. This is a pretty deep topic that we'll be spearheading on Wednesday. And again, it's not light and fluffy, and it's not like academic. It's more day in the life in the trenches. This is what you need to do, and these are the hard-nosed questions that I would ask my traders on the trading floor when I was getting them to perform. Okay. So create a checklist, for your trades. What's the trend? Am I respecting trend? Am I doing a debit or credit? Am I picking a quality support and resistance zone? Have I figured out my risk management? Have I figured out my quantity? All these things that you're going to list out for placing that trade. You know, do you want to adjust your stop losses? Well, only if it's running in your favor. If it's going against you, you shouldn't be widening your stops. So stop loss only get adjusted one way, towards profitability. Can you hit your targets? You can, but I'm not a big advocate of that. You know, to me, it's more important to get the data in the beginning. And so let your winners run, I got you, but normally target needs to be defined before you enter the trade. Okay. So here, a lot of people don't define the max loss monthly, the max loss daily, max risk per trade, and what account size that you're working with. All this should be spelled out. Okay. Last bullet point here, you need a system of accountability. And I used to do this to my traders. You know, if a trader exceeded his daily max loss by 3 times, you know, let's say the trader told me in his plan that he's only going to, you know, max loss will be 150 bucks a day. If I walk over to him and I tap him on the shoulder like, buddy, you know, what happened? You're down 500 bucks right now and still in the trade and still burning a hole in the account. I'm like, do me a favor, will you close out of that trade? You know, and then it's like, well, guess what? I probably suggest you be on the simulator for the next 3 days. You've blown out your risk management, you know, that you should have had in one day or in 3 or 4 days in one day, basically. And so that one's important down at the bottom. You know, create that system of accountability, because that's the hard part about trading. Unless you have a spouse or a friend, or, you know, maybe you teach your dog how to, you know, keep an eye on your business plan or your trade plan, bite your face off if you violate it. You should create a system of accountability, because otherwise, you know, you blow up your account. So have a system of accountability that you punish yourself, and usually it's just don't trade. Now, can you trade on the simulator for several days? Sure. You know, you don't have to stop, but it's like, you know, quit burning a hole in the account. Okay. And sometimes it's emotional. You know, what if you didn't get any sleep? What if you are going through an emotional spell? What if you're having a fight with a spouse or your partner? You know, to me, sometimes there's bigger things going on when you're blowing out your daily risk, if that makes any sense. I don't want to get too, you know, Dr. Phil on you, but these are definitely things to consider. Okay. So here, creating office hours for yourself. And if I were to speak on when I decided to get serious about, you know, my options, my personal options trading, um, you know, believe it or not, I had no options to run a trading floor, because we created synthetic longs so my traders could short on downticks back in the day. And you know, I had to be an option principal and be licensed to be able to run an option floor and all these crazy things, but I didn't know how to trade options from my own account at home to generate revenue. And it was when I was at Schwab, I had two very mature gentlemen that were very just active spread traders. One was like 85, one was 90. It was monumental to see that, because I was like, wow, options need to be part of my journey. From then on, I created roughly 4 hours a week for myself for the better part of a year and a half till I got to where I wanted to be. I literally created office hours for myself. I spelled out a specific day, the time I'd spend towards it, and by and large, I got to where I wanted to be, and I put in the time. So many people, if you're not where you want to be as far as consistency or strategy, create office hours for yourself and you know, apply it. And that's how I got to where I am as an options trader, just putting in the time. Okay. So here, you know, you've heard the expression 10,000 hours to mastery. Set aside the time to learn. Okay. Bite by bite. You know, how do you eat an elephant? That's a fun expression. You know, one bite at a time. Okay. Regular repetition, discipline, simulation, back testing, trade journaling. You know, this is all the unfun stuff, but do the unfun stuff for at least 6 months till you get to where you want to be. Okay. And, you know, to me, I started with stocks, figured that out. Then I went to futures, figured that out. Then I went to options, figured that out. Okay. But every time I stuck to it, I created office hours for myself. I created a trade plan to get consistent. Okay. And keep pushing yourself till you get to where you want to be. Yeah. This is a fun little connection to those who are further ahead than you. Absolutely. You know, the old expression is find someone who's actually doing it successfully and listen. Right? And then this last bullet point, ties in with journaling that we'll touch on Wednesday. But if you have 20 to 30 transactions of the same style strategy, that's a wonderful data point. And the data will literally tell you how to behave. Okay, because it'll tell you duration, it'll tell you ticker selection, it'll tell you strategy that you're implementing. As long as you're creating a checklist on every trade, the data tells you how to behave, because you think you know how to behave and trade. Oftentimes there's many epiphanies that you get by monitoring your transactions. The transactions may tell a different story than what you think you should do, and that's many times that's how it usually works with people. Okay, so let the data be your guide, or however you want to viewpoint that. And we're going to touch again on this on Wednesday as well. Okay. Wow, I went through a bunch. I had to go fast, but hopefully some of you enjoyed this. And position sizing. So I want to circle back to position sizing. I'll be giving you some formulas. So be there, be square on Wednesday. I'll give you some portfolio formulas. I'll reiterate and I'll create like a document for you. I'll put in risk percentages. I'll also do some position sizing with you. I'll run through some formulas on how to do that on Wednesday. So talk to me. Did I shed some light on some things? Is this a good foundation, kind of infinity number one, I guess we could say? Talk to me, group. Is this good? Do you want to see more of this? How about that? Do you want to see more of this? That's a good question. Ooh, call it out. All right. So cheers, everyone. Let me know if you have any other questions. Stay on for just a bit here. And be there, be square. We're going to jump in on Wednesday, and we'll dive into the depths of tracking your trade, journaling to drive consistency. It's the name of the game. Okay. All right, everyone. Thanks for jumping in this evening.